I know you're not specifically focused on sectors here, but Lizanne, what about FAANG? How exposed should investors be at this point, given the tremendous rally they've already had, but the fact that, even on days like today, where we have another sort of broad rally, they lead the charge, but also we're getting some warnings that Democrats are really looking to crack down ahead of the election. Where would you be?
Well, if there's one area where there's bipartisan support in Washington right now, it's taking a hard line on some of the big dominant tech companies. So I think that potential antitrust risk remains regardless of what happens in the election. Our advice around those, we've been calling them the big five, the five largest stocks, which traditionally hit 25% of the S&P on a cap-weighted basis, is that you want to be mindful of consistently paring them back. Don't try to time a pure exit point, but particularly if you're an index investor or that is your benchmark, I think you just want to make sure you are paring back and taking profits in those names. The valuation of those names is not as egregious as what the top five represented back in 2000. There's a lot of comps because the overall PE for the S&P has hit those levels. But the largest five stocks back then, which of course were different stocks except for Microsoft, were trading at a multiple of 60. And the current big five are trading at a multiple of 32. I'm not suggesting that's cheap, but that is an important difference between now and 2000, reflecting the stronger underlying fundamentals of those names now. That doesn't mean you want to just let your winners run and have them represent a much larger percentage of your portfolio, which itself is a risk, especially given potential for antitrust.
Shepard Smith here. Thanks for watching CNBC on YouTube.